The financial system is not broken. It's working exactly as designed, just not for you. While you were taught to open a savings account, build credit, max out your 401k, and trust a financial advisor who gets paid every time you buy something, the families that have held wealth for 4 and 5 generations were doing something structurally different. Not illegal, not secret, structurally different. And the gap between what they did and what you were told to do isn't a matter of opinion or risk tolerance. It's a matter of who the system was built to serve. This is not a story about conspiracy. There's no shadowy meeting, no sealed document, no single moment where the rules were rigged. What actually happened is more interesting and more uncomfortable than that. The system wasn't designed against you in one deliberate act. It was designed for them over 100 years of incremental decisions, each one sensible on its surface, each one compounding into something that functions, in total, like a machine that moves wealth upward and keeps it there. Pay attention to how this was built, not what it does to you, what it was designed to do for them. In 1913, the United States did 2 things that would reshape the financial landscape for the next century. In February, the 16th Amendment passed, creating the federal income tax. In December, the Federal Reserve Act was signed into law, creating the central banking system. Both events happened in the same calendar year. That is not coincidence. They were designed together, parts of a single legislative architecture conceived by a group of men who were, without exception, among the wealthiest people in the country. The primary architect of the Federal Reserve framework was Senator Nelson Aldrich of Rhode Island. Aldrich was the father-in-law of John D. Rockefeller, Jr. He had spent 2 years traveling Europe, studying the private banking systems of London, Paris, and Berlin, specifically to understand how old money in those cities preserved and grew capital across generations. The report he brought back became the foundation of American monetary policy. The Income Tax Code, written the same year, contained one structural distinction that most people working in financial services today have never thought carefully about. Bank deposits and brokerage accounts were treated as financial instruments. Insurance contracts were treated differently. The cash accumulation inside a life insurance policy was classified under a separate legal category, one that did not generate a taxable event when it grew, one that passed to heirs without probate, one that sat outside the standard creditor claims that apply to other financial accounts. This was not an accident. The insurance industry had significant representation in the drafting conversations. So did the banking industry. The 2 groups had different interests, and the compromise they reached produced a tax code with 2 distinct tracks, one for ordinary depositors and one for people holding participatory financial contracts. Aldrich's friends held participatory contracts. His constituents held savings accounts. The savings account track has looked the same for 100 years. You deposit money. The bank holds it as a liability on their books and lends it out at a markup. In 2023, the average American savings account paid approximately 0.45% annually. The average 30-year mortgage rate that same year was above 7%. The spread between those numbers, the 6.5 points of margin the bank earns on the difference, is the business model. The bank doesn't need to pay you well because in the retail deposit market, there's no obvious alternative that gets explained to you at the branch. The insurance contract track has also looked the same for 100 years. A participating whole life policy issued by a mutual insurance company operates on a different mechanical principle. Mutual insurers have no shareholders. Policyholders are the owners. When the company earns a return above its actuarial obligations, the surplus returns to policyholders as dividends. These dividends are classified as a return of overpaid premium, a legal distinction that places them in a different tax category from interest income. The major mutual companies, New York Life, Northwestern Mutual, Mass Mutual, Penn Mutual, pay dividend rates between 4 and 6% on accumulated cash value for most of the 20th century. Through recessions, wars, and the 2008 financial crisis. The Rockefeller family was using this structure by 1910. The Mellons were using it. The DuPonts were using it. The evidence is in their probate filings, made public after deaths in the 1950s and 1960s. Researchers who have gone through those records find the same instrument appearing across families that had nothing else in common. Different industries, different geographies, different political affiliations. What they shared was a relationship with attorneys and private bankers who are paid retainers rather than commissions. Retainer-based advice works differently from commission-based advice. The advisor has no incentive to sell the product that generates the highest fee. They tell you what the structure is and let you decide. Most people never had access to retainer-based advice. They got the branch manager. Here's the mechanical difference, stated plainly. A woman in 1955 deposits $10,000 into a savings account. The bank pays her 2.5%, roughly the going rate at the time. She earns $250 a year. The bank lends her $10,000 out at 5% to a small business owner. The bank earns $500. The $250 difference goes to bank shareholders. She is not a bank shareholder. She is a depositor, which means she is, in legal terms, an unsecured creditor of the bank. If the bank fails above the insured limit, she is in line with everyone else. Her neighbor, who has an estate attorney, puts the same $10,000 into a participating whole life policy through a mutual insurer. The premium funds a death benefit, but the portion of the premium above the mortality cost, the reserve, gets invested by the insurance company in long-duration bonds and commercial real estate. The company earns a return. Because there are no shareholders to distribute to, the surplus returns to policyholders. The neighbor's cash value grows. She can borrow against it at a contractual rate without triggering a taxable event. The borrowed money can be deployed elsewhere. Her cash value inside the policy continues to compound as if the loan doesn't exist. When she repays the loan, she sets the schedule herself. No credit check, no approval process. The collateral is the value of the contract she already owns. This is not a tax loophole. It is the designed function of the instrument. Congress structured it this way in 1913, preserved it through the 1954 Tax Code rewrite, preserved it through the Tax Reform Act of 1986, preserved it through the 2017 Tax Cuts and Jobs Act. Every major overhaul of the American tax code since its creation has left this structure intact. The insurance industry, funded substantially by the families who benefit from it, has lobbied successfully for continuity each time. The mechanism has a name in contemporary financial planning, infinite banking concept, coined in the 1980s by a former insurance agent named R. Nelson Nash. The name is new. The mechanics are not. Nash didn't invent the strategy. He named what old money had been doing for 60 years without publicizing it. The question that matters is not whether the structure exists. It clearly does. The question is why it never became common knowledge the way index funds did, or Roth IRAs, or 529 plans. Why did some financial instruments become household names while this one stayed largely in the domain of estate attorneys and private banking relationships? The answer is distribution, and distribution follows incentives. Index funds could be sold at scale through brokerage platforms with minimal advisor involvement. Every broker had a reason to offer them. They required low overhead, generated consistent commissions on assets under management, and were easy to explain in a 10-minute conversation. The participating whole life policy requires a licensed insurance agent, medical underwriting, a 40-page contract, and a client willing to fund the policy for 5 to 10 years before the internal cost structure resolves. A commissioned salesperson makes more money selling a term policy and a mutual fund in the same afternoon than spending 3 hours explaining a structure the client won't see the full benefit of for a decade. So that's mostly what got sold. The structural problem here is not dishonesty. Most financial advisors are not deliberately hiding anything. They sell what they know, and what they know is what they were trained to sell, and the training curriculum was built around products that generate distribution revenue at scale. Participating whole life is a slow, complex product. It doesn't fit the distribution model, so it was never built into the training curriculum. The families who used it for generations didn't encounter it through a training curriculum. They encountered it through private counsel. Their attorneys and bankers were paid to understand every available instrument and recommend what actually served the client's long-term interest. That relationship looks fundamentally different from a commissioned sale. You don't get it at a retail bank. You don't get it at a discount brokerage. You get it when you're paying someone a retainer to be on your side. And most people never reach the asset level where that relationship becomes economically available to them. There's a second layer to this that most analysis of wealth inequality misses. The savings account is visible. It appears on bank statements, tax filings, and financial disclosures. The cash value inside a properly structured life insurance policy is not in the same disclosure category. It does not appear on a standard balance sheet the way a brokerage account does. It passes to heirs through the death benefit without going through probate, which means without the public court filing that lets creditors, plaintiffs in civil suits, or estranged relatives see what was there. Old money treats privacy as a financial asset. This is not an incidental feature of the structure. For the families that have held wealth across 4 and 5 generations, the consistent behavior is to keep capital in instruments that are not visible to people with an interest in claiming it. Visibility invites claims. Claims require attorneys. Attorneys cost money and time. A structure that keeps capital private is, all else equal, worth paying for. The savings account is public. The insurance contract is not. That difference is not the only one, but for people who think in generational terms rather than quarterly ones, it is not a small consideration. William Bernstein, in his research on multi-generational wealth, found this pattern running through families across different industries and geographies. The ones that held wealth across 5 generations weren't just investing better. They were choosing instruments with different legal characteristics, different treatment in bankruptcy, different treatment in estate law, different visibility to outside parties. The instrument choice was itself a wealth preservation strategy, separate from the return it generated. In 2008, the American banking system came close to systemic failure. The federal government intervened with $700 billion in the Troubled Asset Relief Program. Major commercial banks that had been considered among the safest institutions in the country were, for a period of weeks, technically insolvent. Depositors above the FDIC insurance limit, $250,000 at the time, were exposed to genuine loss. The cash value inside life insurance policies held under state insurance regulation rather than the federal banking regulation was subject to a different set of protections. State insurance guarantee associations provided a backstop separate from FDIC. The legal structure of the claims, contract rights rather than unsecured deposits, placed policyholders in a different position than bank depositors in the event of a failure. This distinction did not become a major part of the post-2008 financial narrative. The media coverage focused on banks, mortgage securities, and the bailout. The financial regulation debates focused on banking reform. The discussion of insurance contract structures as an alternative to commercial deposits appeared in specialist publications and in private banking circles, not on the front page. The people who were already using the structure didn't need the front page story. They had been using it for 50 years. The 2008 stress test was one more data point confirming what their attorneys had told them a generation earlier. None of this requires access to information that is hidden. The state insurance codes that govern these contracts are public. The actuarial filings of the major mutual companies are public. The estate documents of the Rockefeller and Mellon families that use these structures have been accessible through public records and academic archives for decades. The mechanics are not a secret. What is restricted is not the information, it's the relationship. Understanding why a participating whole life policy is structured the way it is and how to use it as a capital management tool rather than simply a death benefit vehicle requires someone who is paid to explain it without a commission on the outcome. That relationship costs money to access. It has always cost money to access. The families that held wealth across generations could afford the retainer. Everyone else got the branch manager. The financial system was not built in secret. The decisions that shaped it were made in Senate hearings, legislative sessions, and actuarial conferences. The records exist. What changed from one generation to the next was not the availability of the structure, it was whether the people advising you had any reason to show it to you. The Morgan Memorandum from 1923 is still in the archive at the Morgan Library. Written request required. The strategy it describes is still available from the same mutual insurers that existed when it was written. The families that used it then still use it now, still compounding across generations, still choosing instruments with characteristics that don't appear on the standard financial planning checklist. Pay attention to where the people who built the system put their own money. That answer has been consistent for 100 years. The account they opened for you was a different one.